Now, so today, the first session, I want to talk about protection. Okay, my first objective, protection. Okay, protection. So this is where the insurance come in. Insurance come in. Disclaimer, I'm not an insurance agent. I'm not here to sell insurance. Disclaimer. So, and of course, all the information I have is actually based on my own personal research as a user. Okay, so some of the information I collate may not be totally correct. So for those who actually know better, I believe some of you here are actually financial planners. Okay, please help. Please help. Okay, please help to contribute. I am actually doing this from the perspective of a user. Okay. So okay, so again, so go back to where we all start off. So end of the day, I have this 4 investment objectives. Protection, wealth accumulation, creative passive income diversification. These are my 4 objectives. So let me start with my first objective first. How do I make sure I'm well protected against unforeseen circumstances? So that's what I actually want to go through in detail now today. Okay, now, so basically, in terms of unforeseen circumstances, the way we see it, or in fact, the generally known, there is these 3. So number 1, okay, because of certain unfortunate event, there's a need for hospitalization, and obviously hospitalization is expensive. So we want to be protected against that. Okay, that's 1. Okay, number 2, there can be certain unforeseen circumstances that after the circumstances happen, we cannot work anymore. We are unable to work anymore. Okay, so we actually need to protect. We actually need sort of like a replacement of work income, so to make sure we can carry on living. Okay, so that's the next thing we want to protect against, or we want to make sure we are covered for. And of course, the third thing is, okay, because of unforeseen circumstances, we cannot provide for our dependent anymore. We have to make sure we are able to take care of our dependents. So basically, this slide, what I'm trying to say here is this: I want to protect. Okay, in the event of unforeseen circumstances, I need to protect myself so that I would have enough for hospitalization. I would have enough for replacement. I would have enough for my dependent. So let's talk about hospitalization plan first. So same thing, this is what I do. I'm going to give you a general overview of what different insurance are, and then how you should create your own insurance portfolio. Okay, so again, I'm not an insurance agent. So like for example, hospitalization plan, I'm not related to income. It's just that it's a very familiar website I'm using in. Okay, so things like, for example, your income shield. Okay, income shield. So now be very clear, what a hospitalization plan here is this. Touch wood, anybody go to hospital, they just cover the hospital bill, full stop. You don't get a lump sum payout. There's no lump sum payout. So there is this bill, then you go and submit, they just pay off your hospitalization claim, full stop, no additional money. Okay, so hospitalization plan also includes treatment. So touch wood, if let's say this particular person got a long-term treatment illness, then they have to get hospitalized. Okay, then it actually covers, but there is no lump sum payout. So please take note, number 1, I think this is very important. I think everybody should have. So if you are not sure whether you have or not, please go and check. What I understand is this: a lot of people have a life policy and they thought they are covered for hospitalization. No. So hospitalization is to claim, is for covering hospital bills. Okay. So for those who have, these are some of the questions you may want to ask yourself. Are you covered to the desired ward level? So of course, you can cover up to B1, A ward, or private hospital. Okay. Okay, so this is something whereby it's not cheaper if you buy earlier. Okay, doesn't mean that the earlier I buy is going to become cheaper. No, hospitalization plan is not something like that. Okay, but the thing here is this: if you buy later, it does not cover pre-existing condition. So if you actually buy at, for example, 60 years old, so by then, you know, a lot of us will have certain pre-existing condition, and that cannot be covered. So yes, it still makes sense to buy earlier so that you make sure that all the conditions are being covered. Okay. Then okay, so for this plan, there's actually a co-payment portion. So most of the time, okay, or they quite deductible. Okay. So most of the time they say, oh, first 3,000 you have to pay. Anything above, then the insurance will kick in. So if you actually want to cover that, you need this thing called the rider. Okay, rider. Then the other thing you have to take note here is this, for hospitalization plan, it can get very expensive as we age. Okay, you can get very expensive as we age. Okay, now, so the next objective for insurance is to replace work income. So touch wood, anything happen to somebody, okay, let's say because of the accident, they cannot work for like 2 years, 3 years. Okay, so they need some money to come in. So this kind of insurance is called personal accident insurance, or either that life and term insurance. Okay, so hope you see the difference. Hospitalization is hospital bill. Okay, if you actually want to protect for replacement of work income, okay, then you should go for personal accident insurance, or what we call life and term insurance. Okay, so basically such insurance, they actually pay one lump sum. They actually pay one lump sum. Like for example, this personal accident insurance pay a lump sum in the event of accidental death or permanent disability due to accident. So touch wood. So let's say this person after accident have some permanent disability and cannot work anymore, or at least cannot work for a period of time. So at least they have this one lump sum for him to tide through that period. So hope is clear. This insurance is not to pay hospital bill one. Your hospital bill should be covered by hospitalization plan. So know what each insurance is for. Also, this one is to replace your work income just in case after accident cannot work. Okay. And for illness, let's say you want to prevent a case whereby touch wood kena certain illness, then cannot work. So this is a bit tricky here. Now the illness, they have certain terms. You have to be very clear what exactly you want to cover against. Like for example, they have this early and advanced stage cancer. They have this dreaded disease protection. They have this thing called terminal illness. They are all talking about different things. The insurance to replace work income, okay, that means to say touch wood, kena this illness, likely this person still can live for another 5 to 10 years. Then you actually want to worry about, okay, how should I actually get money to survive for that 5 to 10 years? Okay, if I cannot work, how do I actually get money? So if you really want to cover for this, that means you have to go for things like early stage cancer protection, okay, which a lot of people don't cover. Now, then the other very common confusion is actually this thing between whole life or term insurance. Okay, so very good. This website actually put down the differences side by side. So number one, whole life is to protect entire life till death. Okay, whereas for term insurance, it can only protect up to a certain age. Okay, so it doesn't mean that you can actually keep renewing this insurance till death. Also something to take note about. Okay, so number two, whole insurance, the premium usually start higher. So basically, whole life insurance, there is a cash element inside. Cash element inside. So you should see whole life insurance in the form of insurance plus investment. Okay, so whereas term life insurance is you actually start lower. Okay, start lower, a lot cheaper. Okay, but then like whole life insurance, there's actually a cash value, but term life there is no cash value. Okay, so these are, in fact, the two main differences here is this. One is protect entire lifetime, one is for a fixed time period. Doesn't protect all the way. Okay, and if let's say, for example, then for whole life, there is a cash value. Okay, for term life, there is no cash value. So whole life, you can think of it as insurance plus investment. Term life is pure insurance. Okay, so this, if you actually want to be insured for replacement of work income, which simply put, touch wood, get that illness, you want a one lump sum, you can consider either whole life insurance or term life insurance. Okay, so once again, these are the insurance to protect against this requirement. Okay, so of course, the other one is replacement of work income retrenchment. Okay, now, so this is probably something we want to pay more attention to right now. If let's say, for example, you are concerned that maybe at age 55 onwards, okay, we may get retrenched, or you want to protect against retrenchment. So 55 onwards, you actually want to have like a income coming in. Okay, I think the need for this is getting more and more real. So a lot of us, unfortunately, once we hit 55, we may be displaced. So to protect against that, you actually go for this thing called annuity. Please remember this word, annuity. So what does annuity does? You provide a single premium. Then after that, it gives you a regular payout over a period of time. So there is a different combination. Like for example, the one I'm doing now is this. I actually get, mine is endowment plus annuity. So at the age of 40 years old, every year I have to pay X amount of premium, X dollar of premium. Okay. Then after that, from 40 to, okay, from 50, I pay from 40 to 50 years old. Then 50 to 60, nothing happened. And from 60 to 80, I get a regular payment back every year. So that is my scheme. So you can actually do it something like, okay, like for example, I'm 46 years old. I do a single premium today. Then I can get regular payout from 55 onwards all the way to 65. You can do that one. So that is, if you are worried of retrenchment, you want certain protection, that is how you should protect yourself against. Of course, the other way to protect is use a whole life insurance. Again, this is what I do. Okay, basically the whole life insurance, there is a cash value one. And by the way, this cash value, you can withdraw if you want to do so. You can withdraw at any point in time if you want to do so. So in fact, this is how I actually have my emergency fund. This is how I store my emergency fund. I don't really have like, or some emergency fund in cash parked in some bank account. No, I actually use this instrument as my emergency fund. Touch wood, anything happen, okay, I can actually go and withdraw from my life policy, life insurance, and that could be my emergency fund. Of course, the bad thing here is this, if you withdraw earlier, the overall return is lesser. The overall return is lesser. That's the only thing you have to take note of. Okay, so yes, you want to cover for this, then this is the insurance for you to cover. Okay, lastly is dependent. Usually we need some other people to take care of dependent when we are not around anymore. So this is actually good enough. Okay, the other one a lot of people forgot to pay attention to is the mortgage loan. Okay, if you buy a HDB, not an issue. HDB will definitely require you to buy insurance for the loan portion, the money that you loan. But if you actually buy a private property, okay, it's not a requirement to get insurance for the mortgage. Then I realized actually a lot of people actually didn't buy insurance. That one is quite risky, which means to say, touch wood, anything, if let's say this person buy a condo, okay, have a mortgage loan, and let's say this person, okay, gone, and he cannot pay the condo anymore, that means the house has to go. That means the family is actually will be in trouble. Okay, so make sure have to cover for mortgage loan.